Good afternoon to everyone joining our session today, or good morning if you are joining us from the West Coast. I'm Sinead Gleason, Product Lead here at Equifax Canada, focused on our commercial solutions, and I'd like to welcome you all today to today's webinar. We've got some great content and speakers lined up for you. In today's session, we'll be taking a look back over the second quarter, exploring how market factors such as rising inflation and interest rates, as well as continued supply chain constraints, have impacted the Canadian small-medium business economic landscape. And for those of you who manage small-medium business credit risk, it's imperative to understand these trends to spot any early warning signs within your own portfolio so that you can effectively manage that risk. And to that end, we'll have a look at how the Canadian SMB market performed during Q2 of this year, followed by a discussion panel. Our panelists today are very well versed in recoveries and insolvencies within Canada. I have the pleasure to have Brad Lohner, founder of Priority Credit Management, as well as Alex McDougall, Senior Analyst, Innovation, Science and Economic Development Canada, Bankruptcy and Insolvency Policy, joining us after the quarterly update. I'm really looking forward to hearing their perspectives on their respective areas of expertise, as I'm sure all of you are as well. Their knowledge is particularly timely as concerns over inflation and an economic slowdown really loom. But before we get into today's content, I'll pass things over to my colleague Sandra Shep, who will walk us through a few housekeeping items regarding the logistics of today's session. Sandra, over to you.
Thank you, Sinead, and good afternoon, good morning, good evening, everyone. Each area within the On24 platform is responsive, so you can maximize or minimize each widget or box on your screen depending on your viewing needs. There's an Ask a Question widget underneath the slide area, so feel free to enter any questions you may have and we'll address them throughout our session today. In the event there's too many questions to get through, we'll generate an FAQ document which we'll send out to you in the coming weeks. Some related content is available for download, but our presentation today in English and French will be available in the coming days. Our session is being recorded and you will receive the on-demand link via email tomorrow. Some additional features you'll notice on the bottom of your screen are an attendee chat, reactions, register now for our upcoming Fraud Trends webinar on September 28th, our survey, which will pop up at the end of the webinar, and contact us. Feel free to check any of those out and provide your feedback. Now let's get started. Sinead, back to you.
Thank you, Sandra. So here we are in September, looking back on how things unfolded in the second quarter of this year. September for me always feels like a period of transition. You know, kids are back in school now, the days are getting a little shorter and the nights are starting to get a little colder. It's also an opportunity to reflect on the summer and plan for the quarters ahead. So let's take a closer look at how things evolved in the second quarter of this year for small businesses as Canada itself heads into a period of transition out of the pandemic period and into the economic recovery period. As Canadian businesses continue to recover, the unemployment rate in Q2 hit an all-time low of 4.9%. Job vacancies, however, are still much higher than pre-COVID, and the average hourly wage continues to climb. Great news for workers seeking employment, although a bit of a challenge for businesses looking to staff up. Canadian businesses are having to pay a higher premium to attract workers out of a smaller pool of qualified individuals. However, while the average hourly wage has risen significantly, it's still sitting below the inflationary rise in many areas, most notably transportation and gasoline prices, which show a disproportionate spike there in the middle of your screen. Part-time workers are feeling the pinch even more so than full-time, as the average wage rise for part-timers has been lower in the last 3 years as compared to full-time. The cost of essentials such as food and shelter, as well as transportation, are outpacing earnings growth. This is illustrative of the inflationary period we're in right now. In fact, inflation has been dominating the headlines for months, and the Bank of Canada continues to increase the overnight rate. It did so in Q2, and as we've seen again in Q3, with more anticipated increases coming. In Q2, Canadian businesses were dealing with ongoing supply chain issues, labor shortages, and increasing borrowing costs. So let's now turn our attention to the results from the Equifax Small Business Quarterly Trends data for Q2 and see how things did play out. So last quarter, if you joined us for the Q1 update, we thought that we might be looking at the calm before the storm as things were looking pretty stable. Well, this quarter's results are certainly something to take strong note of, as the bad weather, small business weather has started to move in. Businesses are taking on more debt, sitting at an average of $37,000, up from last quarter by 4%. Insolvencies are on the rise, and while the delinquency rate generally is doing better than last year, we're starting to see it now rising quarter over quarter. It signals a struggling post-pandemic recovery period. And with those interest rates continuing to hike, the quarters ahead might prove to be even more stressful for Canadian small businesses to manage. We'll explore these trends a little later on when we get to the panel portion of today's session. On this next slide, we're looking at credit demand, which is indicated through credit inquiries. So demand for credit is holding relatively steady since the end of 2020, with the higher growth coming from the low-risk segment. And the story is the same regionally for the most part in the latest quarter. Quebec and Alberta display particularly strong growth in credit demand. We saw very strong new trade activity in the 7 to 24-month-old and the greater than 60-month-old segments. The data that you're seeing here is specific to those financial products or small business banking accounts. The levels of new trade activity is returning to what we saw in 2019, showing recovery from the peak pandemic period. And on the right-hand side of your screen, you'll notice that credit scores are continuing to improve, with the highest risk segments shrinking. Over 20% of new trades are from those lower risk segments, which is a really significant shift from the risk band splits of 2019 and 2020. This could be due in part to adjustments in bank risk policies, and a shift in which types of businesses were seeking credit after the lockdowns ended and businesses started to reopen. But certainly a notable change there. When we look at the industry trade segments, so these are the supplier credit segments as opposed to the bank ones, we're also starting to see a return to those pre-pandemic levels of new lending. The growth here is coming from more established businesses and not the newer ones, which makes sense given the context of supplier relationships. And like we saw with those financial trades, the new credit is coming from businesses with stronger credit scores, with low to medium risk credit scores now accounting for half of all new trades. So far, the shift back to the pre-pandemic levels isn't happening for either financial nor industrial trade originations, which looks like lenders are proceeding with more caution when granting new credit than we would typically see. And given the current economic climate, that's unsurprising. So now let's have a look at the regional new trade activity, looking at a side-by-side comparison of the new financial trades on the left and the industry trades on the right. Perhaps the thing that stands out more for me is the differences in trajectory here. When businesses started opening back up again around mid to late 2021, you could see the rise in new accounts in industrial trades happen rather quickly. But as that has begun to slow down now, instead, the increase of financial trades has started to pick up. In Calgary, the green bar there on your screen has seen the highest growth year over year of all the regions on both fronts. Likely the impact of the war in Ukraine continuing on as the supply for energy and grains and things such as that are not as available as they used to be. So in terms of new business openings this quarter, some interesting data that we're starting to see, some interesting trends. I would consider this as a rather conservative outlook as compared to the previous second quarters. We've tended to see a bigger spike. I've kind of notated the bullets on the bottom of that graph there for the second quarter. And the summer months tend to be the peak season for new businesses to open their doors. But that hasn't happened this year to nearly the same degree. Something to watch out for as increased rate hikes and supply chain continues, because growth will not necessarily be coming from net new businesses as we've historically seen. Rather, growth will come from those more mature businesses that made it through COVID, like we saw with the new trade activity a few slides back. So when we move towards the delinquencies picture, the second quarter of this year also shows a contrast in performance between financial and industrial trades. Delinquencies on the financial trades have slowed this quarter, while on the industrial trades, or those supplier trades, 30 and 60-day delinquencies are beginning to creep up. This could be a matter of dragging out those payments to suppliers in the hopes that cash flow will begin to improve in the coming months. But a possible early indication of an economic slowdown and a potential precursor to financial trade delinquency increases. We're starting to see businesses falling behind on those supplier relationships and maintaining their banking credit obligation positions. So now when we look specifically at those industrial trade delinquencies, we can see that the rise in delinquency rates this quarter are present in every key industry. Supply shortages and supply chain issues are impacting construction, manufacturing, transportation, services, and retail trade. And we're even seeing slowdowns in industries such as finance, insurance, and real estate. No industry is proving to be immune to the shifting tide of the economic environment in this quarter. And so what our collections data shows up to this point is the decline of collections during the pandemic period when businesses were receiving aid. Interest rates were lower and supply chain issues had only really just started. However, our collections data, keep in mind, it's a lagging indicator. So you'll note that in the last period on your screen there, the declining trajectory of this graph has actually started to slow. This could very well begin to change given the increase in delinquencies on those supplier trades that we saw. And this will be great to get into when we get to our panel discussion in a little bit. And when we look at the bankruptcy rate, what we have here, the data is more current and reflective of the present state of what's happening to small businesses in Canada. And it has started to increase while quite significantly. In fact, compared to Q2 last year, we're seeing an 11% growth in the bankruptcy rate. So risk managers will need to pay close attention to their portfolios as this trend may continue upwards in the coming quarters. And across the various sectors, construction and manufacturing are definitely feeling the impact of the current economic environment, showing the largest increases in insolvencies. And regionally, Toronto and Montreal are returning to the pre-COVID levels. Again, these will be areas to pay particular attention to within your portfolios. And so with that, let's recap this quarter's highlights. So the winds of change have started to blow in this quarter, as we were certainly anticipating, and the dynamics have started to shift from what we saw last quarter. Debt continues to rise for Canadian small businesses, with the average balance sitting at $37,000. There were much fewer businesses open this summer than what we've typically seen, and Calgary reported the strongest growth in new lending. Delinquencies on those supplier trades were on the rise, while borrowers appear to be maintaining their financial trade obligation positions. And it was clear across all key industries, with construction and manufacturing having really been hit the hardest. And while collections stabilized in Q2, bankruptcies grew at 11%. So definitely something to watch out for, as I'm sure that trajectory will begin to turn around. And before we get to the panel portion of today's session, I would actually like to take a moment to ask a couple of polling questions. We would like to get an understanding of what level of knowledge our audience has here today when it comes to the two different industry classification code systems. As you may be well aware, there are two different code systems: SIC, or the Standard Industry Codes, and NAICS, or the North American Industry Classification Standard System. So, Sandra, thank you for putting up the first polling question. And audience, if you could just take a moment to let us know which industry classification code system is most commonly used in your organization. I can see the results are starting to come in now. I think the SIC standard has been around since the 1930s or 40s, something like that. It's very well entrenched. And then the North American standard being a little bit more modern, I guess, or more current. So it's curious to know, of the two, which ones are really are they leveraged? Are they ingrained as part of your business practices, or you're sort of you're your knowledge base? I think the results are pretty much in, and it's the NAICS code. So that's interesting to know that that the industries are definitely moving towards North American Industry Classification Standard. That's great, and that was 64% of you. And on the next polling question, I think that we have is, yes. So there are many different levels of classification indicated by numbers. And, you've got the 2-digit sector, the 3-digit subsector, and then there's using the 4-digit plus, and that gets into the industry group or the industry specifically. So what digit classification or aggregation level is most commonly used within your organizations? If you could help us out. These are the types of insights that they're kind of helpful for, I think, even just generally for industry to understand, because we all kind of cross roads and work interactively amongst industries. And it's just curious. It helps us at Equifax as well understand how these two different classification systems are used and to what degree. And so we're leveraging our panel today to gather that intelligence. So I appreciate your participation. And oh, that's interesting. Okay, so we go down, the audience goes down mostly to that more granular level, or the industry group or industry level. Awesome, 74% of you. Thank you very much. That's great insights. And so now let's meet our guest speakers and get their take on the impact of the economic dynamics that we're seeing in Canada today on Canadian small businesses. It's my sincere pleasure to introduce our two guest panelists. Joining me today is Alex McDougall, Senior Analyst, Innovation, Science, and Economic Development Canada, ISED, Bankruptcy and Insolvency Policy. As well, we have Brad Lohner, the founder of Priority Credit Management Group. Welcome, gentlemen, and thank you for joining me today. Maybe we'll start with Alex. Alex, can you tell us a little bit about yourself and ISED?
Hi. So thank you, Sinead. Happy to start off the discussion. And as you said, I work primarily for the Department of Innovation, Science and Economic Development Canada. That's a mouthful. It used to be known as Industry Canada. And this is the ministry that's sort of responsible for working with Canadians, Canadian business, in all areas of the economy, in all parts of the country, to kind of make sure that and improve business conditions for investment, to enhance Canada's innovation performance, increase Canada's share of global trade, and sort of build a fair and efficient and even competitive marketplace. And in particular, I work on sort of the area that we call marketplace framework policy. So marketplace framework laws are laws of sort of general application. They apply generally throughout the economy without prejudice to specific sectors or areas. And they include laws ranging from things like intellectual property to competition to the area where I focus on mostly, which is bankruptcy and insolvency. And in this respect, we're focused just on making sure that these laws work well for Canadians and businesses, and that they remain modern, functional, and up to date with current market conditions.
Great.
And as we pay, of course, close attention to credit trends, insolvency trends, and tune in regularly to your updates here at Equifax as well.
Great, that's great to hear. And how about Brad? Brad, would you mind taking a moment to introduce yourself and your organization?
Sure. Okay. Good morning. Good afternoon, everybody. Thank you. So I've been in the business in the credit collection world since 1986. And so I've kind of been there and done that. Some things that you should know about me, the priority credit management is we do a lot of construction liens, builders liens, oil and gas liens, helping customers to get paid in advance of having to send it to a collection company or to their attorneys. And then if it does happen to slide past due, then of course we take it on as bad debts. We collect it, and it's on a contingency basis, no recovery, no fee. And we also have an office in the United States as well. It runs under a different flag, but we do a lot of business cross-border. Probably 70% of my portfolio is domestic, and about 30% we do international. So we have quite a wide reach. We do a lot of work with trade credit insurance companies, things like that. So it'll be interesting as we get through this panel to sort of touch on some of those points as well. So
yeah, definitely. Great, thank you. So as we saw in the credit trends portion, the impact of inflation, rising interest rates, and the ongoing supply chain strain on SMB landscape is affecting different industries and different regions differently. There are folks joining the webinar today who manage SMB credit risk, and they really need to get an understanding of how to evolve policies and practices and adapt to these increasing risks while supporting the Canadian economic recovery. Maybe I'll start with Alex. Our first question will be for you. And Alex, actually, this is sort of a two-parter. So firstly, what can you tell us about the insolvency framework and the role of government in managing distress in the SMB space? And then secondly, what are you seeing in other countries in terms of effective legislative examples?
Thank you. Happy to talk about that. And I guess on this panel, I can bring some perspective about sort of the legislative and regulatory environment that I hope will be useful to some of the listeners. And I'll be approaching this, as I do kind of in my job from a policy point of view, which is sort of thinking about the system as a whole and making sure it sort of functions well. And so I guess to start off, just some 101 is Canada's legislative framework for insolvency is comprised of sort of two main laws. There's the Bankruptcy and Insolvency Act, which applies to businesses and most businesses and individuals. There's also the Companies Creditors Arrangements Act, which is more for larger corporations and larger restructurings. And the central objective of our legislative system is to kind of, I guess, provide options to businesses and consumers in financial distress. And in these acts, there are kind of restructuring and liquidations options that apply to small business in particular. So on the restructuring side, small businesses in financial distress can opt for a commercial proposal, which is kind of like a deal with creditors for a more sustainable financing term. with the objective ultimately of keeping the business alive as a going concern. Sometimes this also involves the sort of going concern sale of the business to new ownership. And from a kind of policy perspective, we think the restructuring element of insolvency is very important, and try to sort of encourage restructuring over liquidation where feasible, as this better preserves jobs, value for creditors, value for the business assets, which is often lost in a liquidation. So this is particularly true in small businesses. So if you think about the kind of intangible nature of small business assets, the capital of a small business, maybe it's just the entrepreneurial spirit or aspects of the personality of the owner, the energy of the owner. All of that's lost in a liquidation and can potentially be preserved through restructuring. So that's one key policy goal in Canada. But it's not always possible, and where restructuring isn't feasible, there are also liquidation options, bankruptcy and receivership, where the goal, again, is to sort of preserve the value of the assets for the benefit of creditors through the creation of a fair, sort of transparent, and orderly, low-cost process to maximize recovery for creditors. And there's also a kind of market dynamism function associated with bankruptcy as well, where we want to kind of get the assets of the failed business back to productive use, which then helps on the other side of business creation, which we saw a little bit about in the presentation. Not surprisingly, kind of the low bankruptcy, low business creation trends, I think, make sense in this light as two sides of the same coin. And so ultimately, from a kind of system level perspective, insolvency is a fact of life in the market economy, but the objective of policy is to have a system that mitigates the impacts and makes the best of a bad situation. I'll just add a point about that's relevant for some small businesses as well, which is about personal insolvency rules. And so we see with small businesses quite frequently the personal finances of the owner and the business are intertwined. So in the case of personal guarantees, for instance. And for this reason, sometimes the insolvency of a small business will be the lead to the insolvency of the owner through a personal insolvency. And here, Canada's insolvency regime, I think, plays an important socioeconomic function, which is to allow allow those insolvent individuals to get a fresh start through the release of most of their debts, and help get them back into the economy, which can actually, studies show, helps where there's a good fresh start available in the insolvency system, helps sort of promote business formation and entrepreneurship. So during COVID, there's a lot of emphasis, I think, on insolvency prevention in Canada. There's a fair amount of government support to businesses of all sorts. So I won't talk so much about that since it's well-trodden ground, but as things begin to sort of normalize in the post-COVID era, what we're seeing internationally, I think this goes to part two of your question, is what we're seeing internationally, particularly through recommendations being made by international expert bodies like the World Bank, OECD and the UN, is how to sort of make insolvency work really well. Insolvency systems work well for small businesses. And so in these recommendations, there's some concern that perhaps some insolvency laws are maybe designed with the features of large corporations in mind. Insolvency procedures can be very expensive, complex, not always easily accessible to the small business base. And so we're seeing some recommendations from these bodies about how to design more streamlined systems. And a few countries, notably including the United States, Australia, South Korea, and increasingly some European Union countries are now in the process of introducing legislative reforms to make things more accessible for small business. And in general, this would mean sort of less costly insolvency procedures, more automatic, easily able to be resolved more quickly, and with less court involvement. And so, in Canada, of course, we think our insolvency laws are, well regarded internationally, work pretty well, but we do continue to monitor these trends internationally to just ensure that our system is working as well as possible for the small business sector. Thank you.
Awesome. Great. Thank you. Brad, I don't know if you have any additional thoughts regarding I know it was very much focused on government, but on the role of managing distress in the SMB space, and anything that you may be seeing in terms of, other countries around the bankruptcy specifically.
Sure. Well, first, before I get into that, I got a couple of points to make. I just want to thank Alex and his group for having a pretty decent system, because it frees up debt assets that can be redeployed back to the economy again. So, Alex, thanks to you and you guys for having our backs out there. It, like I said, it gets that money back in the economy where it belongs. So gotta love that. Just a couple of points from my perspective. Many jurisdictions that I work in, most notably the U.S., UK, Mexico, Brazil, and China, surprisingly have substantially similar legislation and tools for corporate insolvency. So those are available, and you can monitor those if you want to. In our involvement, typically on the insolvency side, is we help companies to manage their insolvency portfolio. A lot of our larger trade creditors or trade insurance companies, they're foreign, come to us to help for us to monitor those CCAA filings and help them with the dividend distribution. So that's our involvement.
Oh, okay. That's good to know. I'll get to question number 2 then. And Brad, this one will be for you specifically. So what would you say are the most important considerations when working with small businesses in the early stages of distress in this type of environment?
Right. So in my world, we come at it from 2 different perspectives. As an outsource company, so we are calling on behalf of or in the name of the creditor. So the debtor companies think we're the creditor calling, but it's actually us. A lot of companies have outsourced some of that. And then, of course, on the third-party debt recovery side, where it's actually us calling as our company name. And so what we do on the front end, when we're phoning as an outsourced agent, is we focus on the 5 C's of credit. Of course, those are character, capacity, collateral, capital, and conditions. And we try to determine the future financial viability of that business when we're talking to the debtor company. And we try to figure out if that relationship is salvageable, to try and get the arrears portion paid, and just understand the stresses that company happens to be in. And once you have a better picture of what the debtor company is up against, because it isn't necessarily their specific issue, but it could be their customer's customer, right? Because especially in construction, you saw those slides earlier, that we call it the construction pyramid. And when things start to topple, it comes down pretty quick. So could be some things that are outside of that company's control, but we try to figure out what that is. And of course, in the management of the company that we're working for, has some better information, better intel to try and decide, how they're going to mitigate that risk and maybe lower credit limits or, put a, more enforce their terms and conditions, perhaps a bit more rigidly. On the third party side, so that's once a company decides that they are no longer wanting to deal with that particular company, it comes over to us as a recovery. And so my shift then focuses from the 5 C's of credit to just 1 C, which is capacity. And in the corporate, and we'll talk about that in a second, the corporate world, unlike consumers, if you and I as consumers are out of work, we can go on EI, we can live with couch surf with mom and dad, whatever we got to do to kind of make it until we have the next bit of income and we can get back to work. Corporate debt, corporate customers, when they're out of cash, they're dead, they're gone, right? And so I would encourage all of the listeners out there to, if you haven't done it already, to really dive into your portfolio of AR and look at what kind of capacity it is that your customers have, and do credit monitoring, because sometimes what you think is your best customer, when you first granted credit to them initially, their credit scores are going down, and so you don't want to get caught by a surprise with a surprise receivership that you never saw coming. When we do our collection work, we focus on capacity. What is their ability to pay? And of course, the quicker that a creditor can send the file out to their third-party agency, the better, because it just gives us that much more runway to work with. And so what we would do, what I look for is this company operating as a going concern? Are they advertising actively? Because if you're spending money on advertising, that means you're trying to generate new revenue, right? But if the only advertising that's out there is a going out of business advertisement on the radio or something, obviously heads up, there's some trouble. I've seen that lots. Some media companies run out of business, going out of business ads and don't get paid. It blows my mind. Anyway, so just make sure that there's cash coming in, and so what I look for too is if the creditor sends the file to us early enough, I'm going to be looking to the guarantor or the person who signed as a co-customer, which is typically the business principal on the debt. to see what options they have, and that could take the form of a second mortgage. It could take the form of a shareholder loan, some cash injection into the business. But if the shareholder is not willing to pump money into the business, why would the trade creditor want to continue working with them, right? If I don't have comfort in my own business, why should you guys trust me and lend me more money? So we figured that out pretty quick, and we send that information back to our clients, and they can make a more informed decision. Sinead?
Great, thank you. Let's see, Alex, do you have any additional thoughts on sort of those early stages of distress?
Yeah, very interesting to hear Brad's take on it, and from kind of the system level perspective and the government perspective. I think there is increasingly some recognition as we want to kind of encourage insolvency or restructuring over liquidation where possible for small businesses. Internationally, we're starting to see more attention being paid to preventative solutions. So this includes in places like Europe, developing things like early warning systems, using different indicators to identify companies at risk, connecting those companies with advisory services, all sort of on the intuition that if you act early, then potentially a company that might be able to be restructured rather than liquidated, and that would be a positive result. So this is one of the trends we see, I think, in the legislative environment that sort of reflects some of what Brad was talking about.
Yeah. Okay.
Sinead, I've got.
Yeah.
Sinead, you still there?
Yes,
yeah,
I am.
I've got 12 warning signs I was going to share with your audience that if they hear this from their customer, then they should maybe ears should perk up and they might want to pay attention. So here's the 12 warning signs, and this is developed over the last 50 years by all the folks at the Credit Institute of Canada. So it's not me; it's all the professional credit managers out there. Yep. The first one is when you hear that I'm just in the middle of changing banks or getting new financing. Red flag. The loss of an important customer. If you know they've lost a big one, that's trouble. The loss of an important employee or a CFO, manager type person. There's slow receivables, or they have a large bad debt. Of course, that's the domino effect. That's the construction pyramid thing I talked about earlier. Yeah. Lots of broken promises. Messages not getting returned. Writs or statements of claim being filed by their suppliers. You can see those on the Equifax reports. A change of ownership or death of the owner. In that case, you got to do something right away. When they just tell you, hey, I have no money, that should be an obvious warning sign. Mail return and trade rumors, information you're getting from the street and from your sales reps. And number 12, bank financing that includes extraordinary security, such as an assignment of life insurance. So typically where there's smoke, there's fire.
Right. Thank you very much for sharing that. Those are great. All very valid points. Where there's smoke, definitely, usually there's fire. Alex, what are some of the early warning signs that risk management professionals should be looking closely at? That was an awesome, great top 12 list that we just heard there. From your perspective, what are some of those warning signs risk managers can look at that indicate heightened insolvency risk in their portfolios from your perspective?
Well, I'm not sure I'll be able to add much to Brad's excellent list there, so I can sort of reframe that discussion from what we look for in terms of insolvency trends and risk trends in the economy overall, which is sort of more what the government is sometimes focused on. And the obvious thing is there's a strong interest in forecasting insolvency, what the future trend is going to look like. I always go back to the old Yogi Berra quote, which is, prediction is hard, especially about the future. And it's, I think, particularly challenging in the environment that we're seeing today, where the past isn't necessarily going to be a great guide to the future. One thing I'd keep in mind when we're looking at the sort of insolvency numbers and risks for larger an increase in insolvency trend going forward is that during the pandemic, insolvency rates fell to very low, perhaps historically unprecedented levels, completely defying every insolvency prediction model out there. And so when we talk about increases in the insolvency rate going forward, sort of starting in about Q3, Q4 of last year, there's kind of an open question in my mind as to whether we're just moving back from those very low levels and seeing a kind of regression to the mean, reversion to the normal, let's say 2019 trend, where we're still quite far below in terms of consumer insolvencies and businesses insolvency, or alternatively, whether the trend is perhaps the beginning of a larger secular trend toward much higher rates. And so that's very much an open question. The second thing to keep in mind when looking at these big trends and risks, at least with the insolvency number, is that insolvency actually tends to be a lagging indicator for other business cycle trends like recessions and high unemployment levels. Usually studies find anywhere between about a quarter to 4 quarters of a lag between the big sort of macroeconomic recession-related, business cycle-related trends and their impact on insolvency. So we're seeing insolvency numbers today. It's sort of like we're looking into the past in terms of what business conditions were like a few months ago. And so the forward-looking questions still, I think, very much up in the air. And the third point I think I just want to emphasize with the insolvency risk numbers is that when we look at the actual the insolvency statistics, such as the ones Equifax presented earlier, this is a tip of a much larger iceberg of business failure and exit. And this is especially true for small businesses. So when you see the insolvency numbers, you're really only just seeing the formal insolvency filings reported by the Office of the Superintendent of Bankruptcy, which gets their information from insolvency trustees that work on these insolvencies. And this just captures the businesses that file formally, but doesn't really include businesses that, even if they are insolvent for whatever reason, don't enter formal insolvency proceedings in Canada. You might wonder how large that population is of like insolvent but not formally insolvent businesses. And we've done some work estimating that. For example, Statistics Canada tracks all business exits, including those that don't materialize as formal insolvencies. And if you just compare those numbers to insolvency numbers in a given year, in 2019, which is the latest numbers that Statistics Canada have, it's really only about 3% of businesses that that end up in formal insolvencies. There was a recent study I saw from CFIB asking members that if they were in financial distress, would they file for a formal insolvency through a bankruptcy or proposal? And only a fraction of respondents, I think it was 16%, said that they would. And so I think as a credit manager, you have to think, looking at the insolvency number, you want to think about this iceberg effect. You want to think about more than just the formal insolvency numbers when you're assessing the economic risk. And I think COVID has actually kind of accelerated this trend where the insolvency number might not be as representative as it once was. We saw, as a result of Statistics Canada numbers, that they tracked openings and closures throughout the pandemic, and there was a large number of closures, particularly in some sectors, that just didn't result in formal insolvency filings. We don't have a great line of sight as to what's going on here, but my intuition is that increasingly it seems that small businesses are opting for these other exit paths, which may make the insolvency indicator less reliable as a kind of general measure of what you're looking for than it once was. That's all I think we'll say about that. Sinead?
Thank you. Brad, how about you? How would you compare this current environment to what we've seen in the past? Like maybe compared, obviously pre-pandemic or back to maybe even the 2008 credit crisis?
Yeah. So what we're seeing today, I mean, one of the things that I'm kind of encouraged to see, just make a quick comment and then I'll jump into that, is just on Alex's information. I host Equifax credit groups too, which is credit managers get together and talk about their portfolios and what's happening, who's who in the zoo. And it's interesting to watch because if your finance professionals are part of those credit groups, if they're not, they should be. And you can see the train wreck coming if we're monitoring specific companies in specific industries, right? So it should come as no surprise to them. So if they're not part of a trade credit group, they probably should be, just to make sure that they've got a kind of an early warning sign and you can see what's happening within your specific industry, right? As far as the comparisons, I thought a lot about this. In 2008, from my perspective, the Canadian credit granting community was pretty well insulated from the global recession, just because of the strength of our banks, and just generally Canadians' higher aversion to risk than perhaps our neighbors down south. So today, from 2020 until present, many of the sectors in our economy I'm seeing are slowing down due to the banks taking a harder stance on operating loans, which puts pressure, of course, on their cash flow, and companies are even taking longer to pay now than they were before. I'm seeing that in the credit groups. The days sales outstanding are getting longer and longer, and which puts pressure, taking, obviously they're suffering. And of course, the credit card companies, corporate credit cards, are also reducing their risk too. We're seeing that. So corporate credit card limits are being reduced, which of course impacts the payments to suppliers if they're using their corporate card to pay the bills, right? Yep. Specifically in the construction sector, what I'm seeing we have a large construction credit side, like I said earlier, because of our builders liens and things like that. And we're seeing an increase in available projects. So there's lots of work out there, and the size of the jobs is getting bigger, but also so is the cost of the raw material. You alluded to the supply chain issues and whatever's going on, right? So what happens then is this leads companies to apply for larger lines of credit. We're seeing a lot of that. People and the credit groups are checking the credit of their existing customers again because they've asked for credit limit increases. And what's happening is a lot of these companies are maxing out on their credit lines, and so when you're maxed out on your credit line, just like you are if you're an individual, that you're living paycheck to paycheck, and so you hope like heck that money comes back to you. I'm also seeing supply chain issues because of the trade credit stuff that we do, and supply chains are still a huge concern. A lot of the folks in the credit groups are concerned about this for sure. Raw materials like steel, they're not increasing production of steel, so they're seeing longer fulfillment times to get those orders out. Because of the delays in finished product like steel, customers are shopping around like they never had to shop before. They're not shopping for best price. They're shopping just for any vendor that has product available, right? So you're going to see a lot of companies applying for credit everywhere just to see if they can get product in that they can't get from the normal supplier. There's a very noticeable increase in the number of days before a customer will pay. It's almost like the 90 is the new 60 in terms of days sales outstanding, which is not good. Supply chain constraints, that means that suppliers have to make difficult choices, right? So if there's people on the call that have product, who do I sell it to? So what we're seeing is, the question in their minds is, do I leave this inventory on the shelf and wait for Joe customer to walk in the door and buy it, or do I hoard that inventory and save it for my largest customers so they can at least get access to product or raw material, that they maybe wouldn't have had somebody had bought it off the shelf. I'm also concerned a bit about the economic slowdown in China. I'm seeing all indicators for me look like the Chinese, they're still locking down, they're still doing that, and I think 2023 is going to be a tough year in China, and that's going to lead to a downturn in commodity prices and as just, again, continued supply chain issues. So if you're sourcing out of China a lot, if you haven't already made a pivot to somewhere else, that might be something that they may want to consider. The other thing I'm noticing on the construction side is the new housing starts. We're kind of expecting that to decline, obviously, because of interest rate increases and things like that. So I think, the economists that I follow suggest that there's going to be about a 25% decrease in new housing starts, which of course is going to impact the home builders. But still, that number is up significantly from where we were in 2008. So it's cautious, but it's still higher than what it was, before. And just to wrap up, Sinead, I don't see any sort of macro recession in North America yet. I mean, all the companies are posting record profits and things are going really well. The stock market is a bad indicator, of what the value of a company is going to be. So I think that companies on this call would do well to reevaluate their risk tolerances today rather than reacting to the market. So if you have a trade credit monitoring for your AR, I suggest you continue doing that and wait to see what happens. Sinead?
Great. Thank you very much. I really appreciate that. So you know what, gentlemen, thank you. We've just got about 10 minutes left. So I don't know if we have much time left for questions. Let me take a quick look through the question portion here so we can get to maybe one or two questions. I haven't had a chance yet to monitor them. So I know that somebody did ask if there is somewhere where they can find those 12 warning signs. Brad, is that something that is available online or anywhere like that?
Yeah, happy to share it. I'll get back with you after the presentation is done and get you the link to where they can find it.
That's great. Maybe we can include that in our final upload of this presentation as well, so that can be a reference for folks. That's great. Sure. Thank you for that. What else have I got? Brad, how might someone join one of those creditor groups that you were talking about?
Sure. So first of all, you have to be a member of Equifax to participate. And you have to, I don't know if it's mandatory if you have to share your AR data with Equifax or not. I don't think it is, but just once you join Equifax and you're pulling reports, they'll assign a industry category to you. And then depending what part of the country you're in, you're going to get assigned to a group, and then they'll add you to the group, and then the host of the group, like me, would reach out to you, add you to the email list, and it gets you for the online meetings. They typically last an hour, and they're action-packed, and you'll get a lot out of it.
Awesome. Let's see if there's any here around. Okay, there's one here. Nope, hold on. Yes. Have you noticed a reduction in the DSO due to the new Prompt Payment Act in Ontario?
A reduction in the DSO. I can't speak to Ontario because I work with the Western Canadian credit groups. So,
but
gotcha. What I can tell you is when the prompt payment legislation started in Ontario a couple of years ago, they also had a change to their Construction Lien Act simultaneously, and we actually saw a increase in the number of liens getting filed. But I think that was just more people being more cautious, as opposed to it not necessarily working. They've had a couple of years to work their way through that, and that might be a really good webinar topic for folks, because prompt payment legislation happens in Ontario, Saskatchewan, and now in Alberta. So that might be something that folks would be interested in.
Great. There's another question sort of related to that. Do you have a sense of the proportion of small businesses that close down without bankruptcy versus those that do? I don't know if that's something, maybe Alex, if you have a sense of that one?
So it's a very hard issue to get a line of sight into. So there's one estimate that says only 3% of businesses that shut down go through formal insolvency. So that could be as high as 97%. That may be a bit high, but that's maybe an upper bound on an estimate. I've seen other estimates in the range of 10 to 16%. But certainly, I think there would be agreement on all of those different sources that the majority of businesses that exit and shut down do not use formal insolvency procedures. And the only question is it a very large number of, or just a slightly large number of businesses that go through the kind of more informal exit route?
There's another one question here. It says, question for how the government will look to small businesses for repayment of CEBA debt upwards of $5 billion in loans made during the pandemic, December 2023, when we see small businesses stress in cash flow and insolvency growing. I don't know if you have a sense of that.
I can't really comment specifically on that issue, but just in general, I think the government's quite aware of the sort of the leverage situation and the risks, financial stress that some businesses are facing, and aware of the trends in terms of just being a very leveraged non-financial corporate sector, and the fact that the pandemic had an overly large and disproportionate impact on small business is something that government policymakers are aware of.
Yep, for sure. Makes sense. Well, I guess with that, we're just about 5 minutes left, so perhaps we'll end there. I thank you, audience, for your active participation, and thank you very much, gentlemen, on behalf of Equifax Canada for joining me today. Your insights and perspectives are so incredibly valuable, and I sincerely appreciate the time that both of you took to join us. And the audience, I really appreciate the time that you took as well out of your valuable day to join us. I hope all of you found today's topic informative and full of industry insights. And if you like what you saw here today and you're hungry for more, Equifax's next webinar event is happening on September 28th, hosted by my esteemed colleague, Carl Davies, Head of Fraud and ID. I think if we can put that up on the screen, I think we have that there, yes. Carl will be focusing on the fraud trends from the first half of 2022. And so before you log out, I believe that there's a survey link. If you can take an opportunity to fill out the survey, feel free to share your thoughts about today's webinars, as well as any recommendations that you have for future events. We'd love to hear from you and like to keep it relevant. For those of you who dialed in late or would like to share this session with a friend or a colleague, a link to the recording is going to be sent out to everyone in the next 24 hours. And if you attended our consumer credit trends presentation last week, you can find the material, I believe that's also in this platform too, under the related content section. One last special shout out. Thank you to our webinar production team, Stephen, Sandra, Robin, Swarnima, Bala, and Robert, and the entire marketing operations team for helping pull this all together. It takes a cast of thousands to pull these off, so really appreciate the support. And with that, I would like to say thank you everyone for joining us and enjoy the rest of your day.